including the Governor of the Bank of England. I'd ask each member just to very briefly introduce themselves to the committee, starting please with Andrew.
Andrew Bailey, Governor of the Bank of England.
Thank you, Andrew, and welcome. Jonathan.
Jonathan Haskell, external member of the MPC and Imperial College. Thank you.
Welcome, Jonathan. And Dave, please.
Yeah. Dave Ramsden, Deputy Governor, Markets and Banking.
Thank you, and welcome, Dave. And Michael, please.
I'm Michael Saunders, external member of the MPC.
And welcome, Michael. I believe this is your last appearance, because you're about to stand down before this committee. We will miss you, or as some wit said a moment ago, they're not sure that you will miss us, but we will certainly miss you. And thank you very much indeed for all your service over the years with the Bank of England, which has been very valuable indeed. Thank you. So, Governor, could I start with you? Much comment in the press, much comment from particularly Conservative members of the Parliament at the moment expressing dissatisfaction with where the Bank of England is on inflation. As we know from your May report, we're now looking at forecasts of above 10% in the autumn. Much higher figure than was suggested in the last report back in February. And indeed, the ability of the bank to forecast inflation seems to have been rather a miss for some considerable period of time. I wonder if you could just comment on the assertion that many are beginning to make now, that you've really been asleep at the wheel, you should have done far more on the monetary side far earlier in order to get on top of this inflation. We shouldn't be in the position that we are in at the moment. This could have been avoided had you been smarter at what you've done. In answering that, could I ask you to take it as read that we accept that there's a lot of uncertainty, particularly around what's been going on in Ukraine and energy prices and supply chain bottlenecks and so on, and particularly focus on the labour market and the overheated labour market in your response? I'd be grateful.
I'll certainly try to do that.
Thank you.
Yeah. So, I do have to say that we have to obviously take our monetary policy decisions based on the facts and the evidence at the time. I mean, I do see comments around hindsight, and obviously we have to take decisions based on how we see the facts and the evidence at the time. You mentioned the issue of sort of external supply shocks, and I think the best way I can think of sort of putting a sort of calibration onto that is to say that at the forecast peak in inflation that we currently have, which comes in the fourth quarter of this year, so that's when it goes, I'm afraid, over 10%. And I should emphasise that, I do not feel, at all, obviously happy about this. This is a bad situation to be in. But it's notable that 80% of the overshoot over the target at that point is due to energy and tradable goods. So that's the piece that I would put into this category of things that have happened, and particularly the impact on global prices that is coming through to this country. And as you said, I mean, there's been a series of supply shocks going on most recently, and this really is a big factor in the change since we were last here, and in the May report, the impact of the war, Russia's invasion of Ukraine. And of course, we find, I'm afraid we do, as others do, we can't predict things like wars. I mean, that's as you, I think, were implying, that's not really in our power. I'm not sure it's anybody's power, really. It is well-established practice to accommodate supply shocks where they're expected to be transient, but then to not accommodate, obviously, the so-called second-round effects of those shocks. I would also say, before I move on to the labour market, which is important, that a sequence of shocks like this, which have really come one after another with no gaps between them, is almost unprecedented, I think. So let me turn to the remaining 20% of
Can
this.
I just be very precise before we move on to the labour market stuff, the shocks that have come through? Are you saying that really, fine with hindsight to have perhaps done things differently, but as the information was being revealed to you through time in the past, it would not have been reasonable to have expected you to have done anything differently?
I think on that part, I don't think we could. I don't think we could foresee a war in Ukraine. Another factor that we're dealing with at the moment is a further leg of COVID, which is affecting China, which I'm sure you've read about, and appears to be affecting it more seriously than the effects that we saw previously. And this has been obviously a large new issue. the zero COVID policy that China has pursued up till now has caused dislocations in China, but our assessment is that actually it hasn't caused, those dislocations have not caused major economic effects. That's not what we're seeing now. There were some very weak numbers out of China this morning, and the closure of Shanghai, for instance, at times is having a real effect. There's no question about that.
If I could go back a bit further, though, than what's happening in China today, and sticking with the supply side stuff, as it were. So bottlenecks, things like that, no sense that you misjudged any of the impact of that? Or, for example, the shift in demand from services to goods and the extent that happened.
Well, the shift
the effects of the rapid rise of the economy as we came out of lockdown, the inflationary.
The shift in mix of demand from services to goods is interesting because in the UK economy that has really pretty much largely now corrected itself. Where it hasn't corrected itself is in the US. So the US still has a mix of demand which is skewed towards goods. And if anything, the progress that the US was making in readjusting that balance has been disrupted by the recent rise of COVID again. So we had been seeing the US correcting that balance and shifting back to the sort of more the pre-existing services goods mix, but that has now stopped and appeared to have been held up in recent months. So again, it's not just about sort of what are the shocks, but it's essentially what effect are they going to have. And again, COVID outside this country has been a factor in that issue. And the reason the US is important is that globally the increase in goods demand is hugely concentrated in the US. We published a chart, I think, in the February monetary policy report on that. And of course that drives world prices. These are world markets and they're world supply chains and world shipping capacity, for instance. So it does affect us in that sense. In the UK, however, we've seen, as we sort of thought and hoped we would, we've seen a shift back as we thought. So again, putting the transient label on it in the UK has not been, I think, out of place.
Okay. And the labour market, you were going to
I was going to come on to the labour market. Now, of course, it's wrong to say that the other 20% is all the labour market, but obviously the labour market is important here, and we've got a very tight labour market. I think at the last time we were here, I talked about the uncertainty around the impact of the end of the furlough scheme. In terms of the timing of our decision-making, that there were 1 million jobs remaining on the furlough scheme right to the end, which was well in excess of what we had expected there to be, and that we had been uncertain what the effect of the ending of the scheme would be. But of course, we now know that you can't really see the ending of the furlough scheme in the unemployment data. The unemployment rate has continued to come down. It's now at 3.8. And in the forecast we published in the report, we think it will come down a bit further before starting to rise again. But I wanted to pick out something else which I think is important. And again, I want to discuss with the committee because it has been, I think, a very difficult judgment that we've wrestled with. And that is that we have seen a fall in the size of the labour market force. So since the end of 2019, before COVID, we've seen a fall in the size of the labour market of around 450,000. That's about 1.3% of the labour force. Now, put like that, you may say that's not a very big number, but at the margin in the labour force, it is a big number, actually. It's a very big fall in the labour force by historical standards. And it reflects a 3% increase in the number of economically inactive people. And an economically inactive person is somebody who doesn't have a job and isn't searching for one, as opposed to an unemployed person who is searching for one. That's the distinction. So that is, the persistence and scale of this drop has been a surprise to us. We've seen an increase in long-term sickness in that number, about 320,000 people. And so what we've done in the May monetary policy report is to lower the projected view of labour participation. So we're now, our thinking now is to assume that labour participation remains flat. So that's at around 63% of the working age population, whereas we had been assuming it would recover, at least somewhat, We'd thought in February we'd put in a recovery to about 63 and a
Why,
half.
just in terms of the number, there's 320,000 that didn't
Yeah.
go back into the workforce. Why did it take you by surprise, and what mistakes did you make?
Can I come on to that? I mean,
led you not,
I'll tell you the sort of
not reaching
thinking.
that?
So the question you posed rightly is, well, was it reasonable to assume that there would be more of a recovery in participation and thus an easing of the pressure on the labour market that came from that? I mean, the scale and persistence of the fall has been very unusual, I would say. If you go back to the period after the global financial crisis, there was a much smaller fall in the labour force, but it was recovered much more quickly after that. Now, the notable difference this time, as I was saying, and Michael made a very interesting speech on it, included this in a very interesting speech he made last week, is that we've got this long-term sickness element, which is quite large in there. Now, we don't know much, I mean, I have to be honest, we don't know much really about what's behind that. You know, we've discussed it with health experts. We've asked, well, is it long COVID? Is it people with, as some health economists have suggested to me, is it people with other pre-existing conditions who feel insecure about going to work in the COVID era? It's possible. I think if you trace those things out, you sort of reach somewhat different conclusions about what they mean for the return to participation in the labour force in a sort of era when COVID's declining. But what I would say to you is, I mean, I readily admit that, you know, this is an area where we have to be scrutinised. These are very fine and pretty hard judgments to make, to be honest, I have to say. I mean, that's...
I suppose what I'd be driving at would be looking back, which is fine, hindsight's great. You misjudged that element of the labour market, which may now be part of the reason why we're looking at inflation being rather higher than it might otherwise have been had you worked that out earlier. So I suppose I'm trying to unpack what is it could you have done differently? What mistakes, if that's the term, might you have made in not having identified those figures accurately?
I'm not sure it's identifying the figures, if you don't mind me saying so. It's the judgments you make about how they're going to evolve. So
By figures, I mean, it took you by surprise there were so many that didn't return into the labour
haven't
market.
yet returned, haven't returned to work. Well, I mean, I think there is a judgment there. I mean, we haven't seen something like this happen before. We obviously haven't been in a pandemic.
But
before.
Andrew, you've made that point with respect to it, but what I'm asking is something slightly different, not whether it's unusual or it's been seen before, but why was it that you missed that trick? Why was it that you missed
well, I think
the fact
that
that
the reason that
we
we took a view that this fall in participation would unwind to some degree, that we would return to something more like the labour market we had pre-COVID.
But it didn't happen.
But it didn't happen.
What I'm asking is, why didn't you see that it wasn't going to happen? Was it just impossible?
Well, the question is, how long do you give it? That's the question. But, I mean, how long does it take for this thing to either demonstrate that it's going to unwind or not unwind?
Can I just come in to give a bit of framing on this, put it in a slightly longer term perspective, because at the back of the NPR, we did what we always did, which in Annex 2, we accounted for our forecast performance over the last year. So we looked at last February's forecast, so February 2001, and what was the actual outturn. We did, and what you have to remember is last February, we were assuming that the furlough scheme would end, because that was the plan at that point. The furlough scheme was then extended through to last autumn and then ended. So the reason I'm saying this is last February we forecast that unemployment was going to be 6.4% at the end of last year because we assumed the furlough scheme would end. The labour market dynamics would be as in the past. Participation would be higher. Some people would lose their jobs as a result of the furlough scheme. So you'd have much higher unemployment. As it was, unemployment came in at 4.1%, and it's even lower now, as Andrew says. So through that period last autumn, we and lots of other forecasters are trying to work out, what are these different trends that are taking place whilst having to deal with, the furlough scheme finally ending with, as Andrew says, 1 million people still on the furlough scheme right up to near when it ended. So we were trying to judge, how many of those people who were on the furlough scheme would re-enter the labour market, as in go back into their jobs. Turned out a lot more did, but equally at the same time, we and others were discovering this trend towards lower participation, because I think we all learned more last year about, for example, long COVID than we knew, say, earlier on last year. And so I think, and these kind of drivers, I mean, I've been I'm trying to analyse the labour market throughout my career in public service, but to have something like a pandemic, the impact that's going to have both directly on health, but also on, people with pre-existing health conditions, as Andrew says. These are quite challenging things to make sense of in real time. What we think we've got now, and Michael's speech brings it out, is a much better handle, at least on the numbers, of just how many people have left the labour market and how many of those are long-term sick. But all these trends are happening. Meanwhile, the economy is recovering, when normally people would have been brought back into the labour market. You would get kind of encouraged workers effects.
If I could add one thing, I mean, we talked to...
Briefly, if you will, Andrew. Yeah.
So, I mean, I told you before, I think we talked to Sir Chris Whitty every round, and I don't want to hold him responsible, he's not responsible for our judgments, but every time we've talked to him about long COVID, and I think it's fair to say that he's been very open with us, that the understanding of the physiology of long COVID has evolved a lot over the last year.
Was there any survey work of that million? Was it possible to do that, to try and work out what they were going to do? I'm going to bring Jonathan in.
The ONS...
who might be on that point as well.
Yeah, the ONS did quite a bit.
I don't want to interrupt. Forgive me. No. I just wanted, if I may, if I can help on that. So to amplify what Andrew and Dave has just been saying, the rise in 320,000 of the long-term sick who didn't want a job. What's interesting and puzzling about all of this is if you ask the question, how many more people are long-term sick than before, the answer is much less than that. It's actually 265,000. So in fact, what's happened, as Dave was pointing out, is we've had to guess not only the number of people who increase their long-term sickness, but also the working status of the people who are long-term sick. Because the point was that before, 30% of those people worked, and actually that's now dropped to 20% of people who've worked. So we've had to both get advice on the increase in sickness and the participation rate of their sickness as well. I'll say one more thing, if I may. As you know, the ONS does the coronavirus infection survey, and that's been extended, and we now have a handle on the numbers with long COVID, which is around 322,000, if I remember correctly, in February. What we don't have is we don't have that data matched to their labour participation. So we've been unable to go from that data to exactly what their labour participation is to unravel all this stuff. I hope that gives a sense of the lot of moving parts in
How
this.
significant, though, are the other cohort that haven't gone back in, people who just typically over 50 decide that they want a change in lifestyle and they're just not going to go back to work? How significant is that, and what did you do to look at that group and try and estimate how big that group is?
I think there's an important question there, the answer to which we don't yet know, which is we know that there has been a build-up in saving during the COVID period. We know that it isn't at all evenly distributed amongst the population. And so the question that, of course, immediately occurs to is, well, what proportion of that group is going to use that saving to support itself for some period of time, but expects after a while to go back to work? And what proportion has said, actually, I'm going to sort of recalculate my sort of lifetime, outlook, recalculate my sort of assumptions for retirement income and actually retire permanently. And of course, it seems to me there's no reason why those people should be fixed in their view on that over time. They can change their mind on that over time. So it's again, I just have to say to you, it's a very hard judgment to make.
But what was the bank and the MPC doing to try and establish in your own minds how big that cohort might be?
Well, we do a lot of taking of the evidence, and we start with the quantitative evidence, then we look at surveys. There are useful surveys out there, of course, of people's intentions, but they do change over time. So, we have formed views on that to embed in our surveys. And by the way, I don't think that retirement question is particularly the issue necessarily in where we are on the forecast. Okay. At least not yet, anyway. I mean, of course, it could change over time. I think the health.
Sorry, Andrew. Thank you. Just conscious of my time, there's one other thing I want to address, which is Michael, Jonathan. You both supported a rather larger hike in the interest rate compared to Andrew and Dave. And I wonder if perhaps I could come to both of you, but start with Michael. Why was there the difference in judgment, do you think, between yourself and our other two witnesses today, and indeed most of the rest of the committee? What is it that you think that they're not actually signing up to, as it were?
Well, if we step back for a minute, the MPC loosened monetary policy significantly during 2020 as the economy shrank, as the pandemic developed, in order to support the economy and to head off risks of below target inflation, big rise in unemployment, lots of business failures. And I think that was completely the right thing to do. I think that policy easing was very important in supporting the economy through that period. But I mean, it's a matter of public record. I was voting to withdraw some of that stimulus from the middle of last year and have been through the first half of this year. And I felt that as the balance of risks around the economy shifted, the tightening in the labour market, that we should move more rapidly back towards a more neutral policy stance. At the moment, the economy has a significant amount of excess demand. Capacity pressures are widespread across firms. The labour market's very tight. Underlying pay growth has picked up to above a target consistent pace. Same with service sector inflation. And inflation expectations are uncomfortably high. So I would rather that we move back to a more neutral policy stance. I think the advantage of doing so would be to try to ensure that that mix of relatively strong pay growth, service sector inflation, and inflation expectations does not become more firmly embedded.
Do you feel that your views on the dangers of an overheated labour market, that you were kind of getting on top of that notion rather quicker than other members of the committee? Is that effectively the position? You don't have to be modest.
No, I think it's easy to see these things with hindsight. At the time, we're all making decisions which are often quite fine judgments amidst great uncertainty. So I think one has to be careful about sort of doing the hindsight view. And I do think the rise of long COVID and the drop in workforce participation has been a major development that it would have been hard to foresee a year ago. But as the evidence has come through, we've tried to take that into account in our forecasts.
If your view had prevailed in this meeting and previous meetings where you appear to have had a rather more concerned view of what's been happening in the labour market than perhaps other committee members, how much of a better position do you think we might be in as a consequence when you think about inflation and the de-anchoring of inflationary expectations from the 2%, which is where we seem to be at the moment? Do you think we made a big difference? Or
I think we might be in a somewhat better place in terms of inflation expectations. To be fair, though, I think had we entered the QE programme early, the current inflation rate and the prospective inflation rate through this year really would not be very different. The scale of the energy price shock and the rise in food prices and the rise in global goods prices, which is largely driven by events outside the UK, is such that even a slightly tighter monetary policy stance through last year would still this year leave us with inflation well above target. And there's really no sensible monetary policy which could have been put in place a year or two ago that could have kept inflation at the 2% target this year.
But it would have helped in trying to anchor down inflationary expectations and perhaps cool down that labour market, those wage inflationary pressures that we're now seeing coming through.
Somewhat.
Had there been earlier,
somewhat, but I do want to stress the judgments which are being made amidst uncertainty and the risk of looking back with the certainty of hindsight.
Very quickly, Dave, then I'm going to come to it.
It's just because I mean, like Michael, I was voting for a modest tightening a little bit earlier, so through the autumn of last year. In fact, just after I came to this committee, I started to join Michael. When I last came here in August last year, I then started. I started to vote in the minority for a tightening, but I would want to associate myself with the thought that it would make a difference only at the margin. If it made a difference at all, because as Andrew was saying, 80% of the overshoot is to do with first round effects, to do with the shocks that have hit the economy, and so you're only talking about the behaviour of firms, the behaviour of bargainers in the labour market for the other 20%, and these are so you're talking about a very small part of the inflation overshoot that we've seen.
So is that to go as far as saying, well, almost anything you did on the monetary side with interest rates in the past could not have been expected to have brought inflation much closer to its target? Because this 80% is kind of beyond the reach of monetary policy. You can't control energy prices, and
over this
therefore
period,
we are where we are because monetary policy was never going to really do the job.
Monetary policy was not going to do the job in these circumstances. I think that is a very important point. I think the tightening that we've been doing in monetary policy since December is having an effect. I mean, it is putting up the cost of borrowing, so it's dampening. We'll come on to that, I suspect. Monetary policy, it can have an impact, but we have to recognise that the first round effects coming from these shocks, because we import a lot of goods, so that all the supply chain effects we were talking about previously, China and all and China has come back in, all of those count. Then you've got the energy price shocks that we were seeing before the invasion of Ukraine. These are things that typically throughout its history, we and others, the MPC has looked through. It looked through those kind of effects after the global financial crisis, those kind of energy price shocks. What's happened this time, as Andrew was saying in his opening remarks, is that we've had a series of these shocks, which I think does then play into Michael's point about inflationary expectations and second round effects. Because if you're a business, think about what price you can set. If you're in the labour market, you keep seeing these shocks hit. There is the risk that your perception, your inflation mentality may change, and you think we're in a more inflationary environment because you get one shock after another and you think it's going to be sustained. So I think all of us on the committee are absolutely focused on making sure that medium-term inflation expectations don't de-anchor, which would take us away more persistently from the target.
Thank you. Very finally on my section, Jonathan, do you want to come in on this point about your position on the interest rate?
Thank you, Chair, but in the interest of time, I won't repeat what's been said because I agree with much of it. I'll say one thing very quickly, since you're asking us to account for ourselves. I made a speech in Glasgow in November, which looked at the status of the labour market. We had data until September. And at that point, what was happening is that unemployment was falling and vacancies were rising very sharply, but those numbers seemed to be in line. That is to say, the increase in vacancies did indeed reduce unemployment as those unemployed people filled the vacancies. And what I said at that speech is I said I would become more worried about the labour market if it were the case that vacancies were to carry on going up and unemployment were to stop falling quite so quickly. And that is indeed what we've seen, and there's a chart in the latest NPR which essentially sets that out, that there's a lot of vacancies around, obviously, and relatively few unemployed. I think that's come as a surprise to me, but I tried to indicate that that's where I would go, and then I've followed that logic.
Okay, that makes sense. Thank you. Gareth.
Thank you, Chair. I want to talk about the future and your future projections for inflation. Governor, what do you see as the main risks to your projections going forward?
Well, let me just put the picture in the future in terms of what is driving the picture of inflation, and then I'll tell you what I think of the risks. The main driver of the profile of inflation, and particularly what brings it down, is the very big real income shock that is coming from these outside forces, particularly from energy prices now, and still global goods prices. And that real income shock is going to have an effect, obviously, on domestic demand, and it is going to damp activity. I'm afraid, as we say in the projection, it looks as if we think it will increase unemployment. And that will have a much bigger effect than the effect of increases in the bank rate that we do. That is the big driver in terms of the downward sort of pressure. And by the way, that's also what's putting us in this challenging position at the moment. We've got what we think of a trade-off, where the pressure upwards on inflation is being matched by a downward pressure from the real income shock coming in, and managing our way through that. I've used the analogy of walking a very narrow path. That is a very challenging environment to be in. So that's the backdrop. As I said before, I mean the remaining pickup that we're going to see this year, other things equal, is coming predominantly with 80% coming through energy and traded goods, and I'm afraid Ukraine is obviously the biggest driver of that. Now, the risks, as you said. As we said in the report, I mean, we do think that there is, our central case is that inflation comes back to target. In fact, it goes below target in the third year. But there are risks. We put the balance of risks on the upside. And the risks there, I think, are unfortunately quite a number. There is both domestic and non-domestic. So the domestic risk, I think, is exactly what we've been talking about, which is that the labour market doesn't cool down. We might get more dissaving. More than we expect of these savings will get used to support demand for longer. That's possible, of course, because there's been this build-up in saving. And again, it's a very challenging judgment because we haven't seen that type of pandemic-related saving. I mean, it's worth saying that when I go around the country, as I do a lot, and talk to businesses, they are still very focused on how do I hire people. I mean, there's this very interesting conversation we have where they want to talk about how they hire more people, and we're talking about the concerns we have about the shock to real income and what it will do. So that's a domestic risk. On the overseas side, I think we have risks from all the things we have at the moment. So clearly we could get more supply chain disruption in China. Ukraine, I'm afraid, is the big one in a way, and I'll boil that down to two things. One is obviously an further energy price shock. I think that would now come more from the cutting off of gas and distillate supply. So that's distillated products like diesel. Ukraine and Russia, I should say here, because it's a combination of the two of them, obviously. Crude oil isn't so much the issue. I think it's what would happen from a disruption. And then I'm afraid the one that I'm going to sound, I guess, rather apocalyptic about is food. So when I was in Washington at the IMF World Bank Spring meetings a month or so ago, and we had the Ukrainian finance minister there. I did spend most of my time in meetings. People think I spent most of my time walking out of meetings. I didn't actually, but only when the Russian finance minister came on. But I have to tell you that I think this is a big concern, because I think two things that the Ukrainian finance minister said. One is Ukraine does have food in store, but it can't get it out at the moment. Two, while he was optimistic about crop planting, as you know, Ukraine is a major supplier of wheat, major supplier of oil, cooking oils. And he said, he was pretty optimistic about planting, interestingly, but he said at the moment, we have no way of shipping it out. As things stand at the moment, it's getting worse. And that is a major worry, and it's not just, I have to tell you, a major worry for this country, it is a major worry for the developing world as well. And so if I had to sorry for being apocalyptic for a moment, but that's a major concern.
Okay, thank you. You mentioned the United States a couple of times.
Yeah.
The government in this country has announced a series of measures to tackle the cost of living. Some are calling for even more measures. To what extent have you factored in, fiscal policy risk to your projections?
Well, we always use announced government policy as a conditioning assumption. We don't speculate on what government policy might be in the future. We use announced fiscal policy as the conditioning assumption.
So you've not factored in the fact that there there may be additional measures coming down the track.
No, that's not. I mean, I think that's a long-held MPC policy. I think it's the right one. It's not for us to speculate, I think, on what the government might do.
And on Ukraine, to what extent are economic sanctions a part of your projections going forward?
Well, I mean, all the things that I've just been saying, of course, get picked up because we use market prices for commodities. So we use market prices for energy and for food goods. I mean, just to give you an example, the world wheat price has gone up just under 25% since I think we were at the last hearing. So we use those prices, and of course those prices will therefore, include a view of what could evolve. But I have to tell you, based on what we've seen over the last year, and going back to our earlier discussion, there's a lot of uncertainty around this situation, and you see it. Let me take the natural gas price, which is the best example. So, natural gas prices have fallen over the last month or so. They were very high during the early invasion period. The spot price has fallen, but the forward price has not anything like as much. And of course, the off-gen calculation is based on forward prices, which is why I'm afraid we've got a sort of leg up in that later this year. I mean, interestingly, the UK spot price is now well below the continental European spot price because we've had a big inflow of liquefied natural gas. It's great work by the people who are, doing this. If we can keep that up, but it's next winter that's the critical period for that.
It struck me that reading the report and actually in your responses to our chair that I think you said 80% of CPI is due to external factors, and to a certain degree raising rates, you say, I think, would have had very limited impact. Have you felt a bit helpless through this period? Well,
yes. I mean, it is very, very, more than uncomfortable. I'm trying to think of a word that's even more severe than that. I mean, it's a very, very difficult place for us to be in. I mean, to predict and to forecast 10% inflation and then say, as we were saying a few minutes ago, and there's not a lot we can do about 80% of it, I can tell you, it is an extremely difficult place to be. I mean, we have to recognise the reality of the situation that we face. And let me be clear. I mean, I please do not interpret anything I've said as a criticism of the situation in Ukraine. I'm very supportive of what's going on in Ukraine, and we have to live with it and deal with it.
You're saying basically raising rates will have.
No. Don't interpret that. I mean,
can I come in on that? Because you were saying you were looking ahead. So I think a really instructive comparison is we publish a path of. We publish obviously our central forecast based on the market rate for interest rates, but we also put detail in the document in the monetary policy report. What would be the path for the key forecast variables if we took interest rates as constant? So if you look at the constant rate path, and you need to compare it then with the main market rate path. The market rate path has inflation coming back to, it falls from the peak at the end of this year to 6.6% in quarter 2 2023, and then 2.1% in quarter 2 2024. So 2 is out. If you take the constant path, so you don't assume that market rate path, but assume rates are at 1%, inflation would be on that scenario 2.9%. So in 2 years, that's inflation still well above target. So that does show that policy does have we're not saying policy has no effect at all. Policy can have an effect, and in our forecast is having an effect. That's very important to. Both to bring actual inflation down, but to ensure that the inflation expectations stay anchored.
Yeah, if I can come in on this, monetary policy cannot prevent the rise in energy prices and global costs from pushing inflation up during the course of this year, and thereby reducing living standards. But it can ensure that as that shock fades, inflation returns to the 2% target. And it's in order to ensure that we have been raising interest rates, in order to make sure that we get back to 2% inflation on a sustained basis.
Thank you. I'll leave it there.
Thanks, Gareth. Very quickly, Anthony.
Can I just ask a very quick
yeah,
follow-up?
please.
You mentioned your frustration in inflation going up 10% and not being able to control it in the short term with monetary policy. And I presume you don't advocate policies that we had when we last had rampant inflation, like price controls and wage controls. No. But do you think there's anything else that could have been done to control inflation, or is there really nothing? We just have to see it rise to that level before it comes down again?
Well, I think, going back to what I was saying a moment ago, I'm very careful. I don't advocate policies that the government should adopt. I don't think the government has things in its hands that it could do particularly. What I would say is that I think the really impressive work that's been done on gas supplies, I think we need to keep it up. I mean, if you look at what we did on vaccines, the procurement, it made a huge difference. So I think ensuring gas supplies is important. I think, and I'm by no stretch of the imagination a military strategist, whatever can be done to help Ukraine get its food out of the country would be a huge contribution. And I mean, the third thing I'd just say, and again, I'm not advocating government policy, I think going back to the conversation, the very interesting conversation we had at the beginning about the labour market, I think, the more we can do to understand what is actually, going to shape the people's sort of participation in the labour market going forwards, I think the better. Understanding it is a good thing.
And if I could just add to that, what you get from, we talk a lot to businesses through the agents network. I mean, I did a visit to Wales at the week before last. And what was striking from talking to a number of businesses is how they're looking to build the resilience of their supply chains. So in a sense, the behavioural response to what we've seen. So they're looking, for example, reshoring where possible, supply chains. So you get that certainty of supply. It may come at greater cost in the short term because, globalization created the more extended supply chains in the first place. They were more efficient. Then when you see the kind of shocks that we've seen from the pandemic and now from the war in Ukraine, less confidence about those very extended supply chains. So you're seeing it's not just about what policy could or couldn't do. You're seeing businesses, you're seeing the private sector respond and thinking how it can build resilience. Now that may be at a cost in the short term, but it may give you less less of a response of the economy to the shocks, that whatever the shocks are that will inevitably hit in the future.
Shannara.
Thank you, Chair. Governor, you seem to be getting it in the neck lately from Conservative politicians in particular because of inflation. Liam Fox, some members of this committee, and I'm sure it will continue. And it does seem like a bit of a coordinated attack on the bank, in my view. How do you feel about that? And do you think the independence of the bank is at risk?
Well, I don't live in the world of anybody's politics actually. So I'm afraid it's not a world that I particularly respond to at all. Actually, I read about it, but I don't respond to it.
You have read about it.
Sorry?
You have read about it.
I've read about it. Yes, I do read newspapers.
And so much. I mean, just going
on
to
the
the
independence
substantive
point
about independence.
Yeah, no, that
Cabinet ministers are reported to have had to come in and reaffirm the independence of the bank in light of some of these criticisms. Are you concerned that there is this chipping away of the bank's legitimacy in the current context?
Well, I'm always concerned about ensuring that the bank's independence is preserved and is understood. I have to say that this is the biggest test of the monetary policy framework that we've had in its 25 years. No question about that. What I would say to these people is, this is when both the independence of the bank and the target framework and the nominal anchor matter more than ever. Frankly, I mean, more than in the good times, as it were, the easy times. This is the point at which it is, and people often talk about the 1970s and what's the difference with the 1970s. Well, the big difference with the 1970s is that we didn't have an anchor. We didn't have a nominal anchor in the 1970s. We didn't have a monetary policy anchor, and what you got in the 1970s was a high rate of inflation that persisted across the whole decade.
Does anyone else want to come in on this particular point about independence and some of the criticisms that we've heard about in the press? towards the bank.
I mean,
Yeah, go ahead.
merely to agree with what Andrew's just said, that the importance of independence and the importance of the target are even greater in times of maximum stress.
And I think all I would add, and it comes back
They need to call off the dogs, do they? The people who are attacking.
No, all I would add is that the discussions today are critical to that legitimacy, because it not only do we have an independent MPC, but a central part of the reforms that were done in 1997 and subsequently consistently applied were transparency and accountability. So we try and put as much information as we can out there, including, for example, that forecast comparison I gave you, and then you hold us to account for it, through discussions like this and wider debates in Parliament and throughout society. And it's that accountability, I think, is a central underpinning, whether Parliament or through our efforts with the public, to sustaining the position that we're in.
So I've got my next question's about wages, and as the chair mentioned, that obviously wage pressures on inflation has been referred to in the past. There was a particular policy decision that the government made about city bonuses, and which is the subject of an article reporting to the IFS's study. That says that the return of bumper finance industry payouts means that the top 1% highest paid workers were beginning to pull away further from the rest of the UK workforce, despite the cost of living crisis hitting the country at large. So, that's not a decision the bank made. That was a government policy decision. So when there is a discussion about wage pressures, inflationary pressures, and demands for increasing wages, which is understandable if you've had wage freezes for a decade, and there's a decision in parallel that a government makes to allow for city bonuses. What do you say to that? Are there inconsistencies in the way we talk about wage pressures?
Two things.
I know you ran into hot water when we last talked about wage pressure, but is there some rampant hypocrisy here in people attacking in central banks like yours, while failing to act to bear down on wage pressure that is a direct consequence of government policy?
I'm not quite sure which government decision is referring to. I mean, what the government hasn't. I mean, obviously, when we onshored the EU financial services legislation, we inherited the bonus cap, and nothing. The bonus cap is still with us. I mean, nothing's changed. Obviously, that's with the government. It could be changed, but it's not been, and I'm not aware of any move at the moment to do so. So that hasn't changed. So I'm not quite aware of what government policy that is. I mean, let me say on the second part of your conversation, I mean, my view, and I was asked about this in an interview the other day, is I do think people, particularly people who are on higher earnings, and people, should, think and reflect on asking for high wage increases as a matter of, it's a societal question. I'm not preaching about this. I was asked if I'd, taken a pay rise myself this year, and I said no. I'd asked the court of the bank not to give me one. Because I felt that was the right thing for me personally, but everybody must make their own judgment on that. It's not for me to go around telling people what to do. In that sense, I know I may have been interpreted as doing that at the time, but I wasn't saying that. What I was saying is I think people should reflect on it, particularly people in that situation.
Just turning to the question of where the labour market pressures, Adam Posen talked about the impact on the UK is going to be the sustained impact, argues that inflation is likely to be more sustained in the UK than in the European Union because of its labour market being tighter due to lower levels of immigration into the UK from leaving the European Union. Do you agree?
Well, I think the point Adam was making was that if the UK becomes a more closed market post-Brexit, then it becomes somewhat more inflexible. I think the challenge at the moment in judging that is, and it sort of goes back to what we were saying earlier, that the biggest impact, first of all, the biggest impact so far in the labour market is it appears to be COVID related. we think there is a net migration number there as well, but it's a smaller number. We think it's a hard number to calculate at the moment because the data are not very good. And secondly, it is very hard at the moment to separate the impact of COVID and the impact of Brexit in this area, because both of them have, I think, reduced the cross-border flow of people, of migration. And that's certainly what employers tell me when I talk to them. So I think in time we'll know the answer to that. But at the moment it is very hard to make that judgment because COVID is having the same effect.
So Dave, did you want to come in on labour shortage, or Jonathan Haskell?
I mean, the only thing it actually goes back to a point I was making earlier about my most recent visit to a set of businesses in North Wales, is that, again, you are seeing businesses adapt to the world that they're in. So you're seeing more and more examples of businesses having to do their own training in order to deal with, for example, skill shortages. To pick up on something that when I was last here we talked about, you particularly see it, for example, in the haulage sector. More and more HGV companies are now, as it were, growing their own, taking people from warehouses, developing their skills so that they can then over time take on the more, pass the qualifications and become HGV drivers. So you are seeing, again, the economy, the private sector, as it were, adapting, supported by policy, changes in regulations and stuff at the margin. So but back to Andrew's central point, you really can't, with so much going on as the economy responds to a whole series of shocks and changes, Brexit, the pandemic, energy, the war in Ukraine, it's impossible to disentangle different effects and the interplay of different forces.
Jonathan and then Michael.
I just wanted, if I may, just to have a word about bonuses that you're asking about. I mean, you're quite right that they make a difference. So average wage index excluding bonuses year on year to February was 4.7%, including bonuses is 6.4%. Actually, it turns out that we don't measure all of the bonuses you might want to measure, like signing bonuses in that. So if you put those into a more comprehensive measure, you get 7.3%. But the point I was going to make is those bonuses have spread out a long way beyond financial services, actually. Whilst it's true that financial services in normal times account for the lion's share, they spread out a long way beyond that. I believe there's a story in the Times today that EasyJet are offering a £1,000 bonus, conditional upon various things, to some of their crew. So I think it's not just the financial sector which is paying these bonuses, actually.
Michael, did you want to come in?
Yeah, Brexit has reduced the UK's potential output, and that's through adverse effects on business investment and hence productivity, and also on labour supply. And it may also have increased the extent to which, if there is excess demand in the economy, that inflation picks up, because the UK's labour and product markets are less open. But it's wrong to think that this will be a cause of persistently high inflation in the UK. The MPC has the tools in order to ensure that inflation returns to the target. And we've shown our willingness to act accordingly. So you could regard it as a factor affecting potential output, but not a reason for persistently high inflation.
Actually, I was making the point about wage pressures and labour, supply of labour. The earlier discussion about, in relation to the chair, about labour shortage and, well, your point about bonuses being offered. In substance terms, obviously energy prices are the main drivers for inflation, according to your own report. But just trying to understand better where all these different pressures are coming from. So individually, they may not be the significant one, but they play a part, do they not?
Look, there's an issue of domestic capacity pressures across all sectors, really. That the recovery in the economy, welcome, has outpaced the economy's potential output. And you see capacity pressures across all sectors. You see it in the labour market, you see it in capacity use in firms and in pay growth, not just at the top end, but it's a widespread pickup in pay growth, and in services in inflation. So monetary policy is really trying to ensure that domestic inflation pressures don't remain persistently high.
And what impact is there of a fall in sterling on inflation?
Because we import a lot of goods, a fall in sterling will put up the price of those goods. But back to Michael's central point, we although there's all these things going on in the economy, and it's an unusual period for that. Certainly when you compare it back to the kind of first 10 years that the MPC was created, it was called, one of Andrew's predecessors dubbed it the nice decade. It was also known as the Great Moderation globally, as China entered the global economic system. Nevertheless, we still, as a monetary policy committee, whatever's going on, including with the exchange rate, we have the tools to bring inflation back to the target in the medium term, and that's the critical thing. And when you look, and through the period of the 25 years that we've been in existence, we've seen lots of exchange rate moves, and the exchange rate has depreciated over time. But over that period, inflation has averaged 2%. Over the whole period. There's been quite a lot of volatility, particularly recently, but also for some of the earlier energy shocks. But inflation has averaged 2%, and we will deal with what happens with the exchange rate. We're an inflation targeter. We have to take account of the exchange rate, and we'll deal with it to ensure that we get inflation back to target in the medium term.
I'll just say, it's worth noting that although, of course, we measure it against a basket of currencies, the biggest depreciation has been against the dollar, but that's been true for many other currencies. And the reason is, I talked earlier about this trade-off situation we're in, growth going one way. The US is in a different place. The US has got a demand shock, effectively. Demand and inflation are going up. And that's why the Federal Reserve has actually given stronger messaging about its interest rate path, and indeed has raised by 0.5. And a lot of that relative change in interest rate expectations has influenced the movement in the exchange rate.
Did you want to come in?
Thanks, Roshana. Yeah, Emma.
Thank you. Just a really quick one. Mr. Dave, you were talking about the private sector adapting to the labour market shortage. I just wondered whether you were seeing a move towards recruiting more remote workers as a way of opening up new labour markets in response to that labour shortage.
You're certainly, depending on the sector, you're certainly seeing that being another factor that employers have to take account of. I visited Airbus a few 10 days or so ago. Obviously, their workers can't be remote. They're manufacturing wings up at Broughton to the highest possible standards. But then you go to another sector where which will be more like professional services or something like that, and you see much more evidence of hybrid models and workers expecting to be able to work remotely. And then you might go into some sectors like technology, where it's a global sector, there's global talent, and a lot of people in that sector expect to work remotely 100%. They're doing code or something like that. So you've got that kind of spectrum, and we see it. You then have, of course, people in very manual work, farming community, that kind of thing. They have to be there all the time. So it's a range, but what you're seeing is it's back to how businesses and workers are having to adapt to the new normal post, particularly post-pandemic, which is a completely unprecedented event and has created all these different expectations, but also, as Andrew was saying at the outset when we talk about labour market participation, generated new concerns for people. So, if you do have a health concern, whether long-standing or related to COVID, and you can now work remotely, that must be, a huge reassurance compared to if you had to travel on public transport, something like that. And we pick it up in every single discussion with businesses that we have.
I think it's, in some parts of the economy, it's changing regional wage differentials. Yeah. I'll give you an example on visits I've done. Law firms, so regional law firms now saying that they're having to compete with London law firms at London law firm rates. With London law firms, I got this in Cardiff, got it in Leeds, saying to lawyers in Cardiff and Leeds, you don't actually have to come to London often, and we'll pay you the London rate to be a lawyer in Cardiff or in Leeds.
Brilliant news.
I was simply going to add, and it goes back to the earlier discussion that we had with Mr. Brown about what could actually be done. 30% of people who reported themselves long-term sick before the pandemic used to work, and were actually working and participating. And you would think, with the increase in remote working, as Dave has just described, that number might go up because there are more opportunities for those people. And actually, it's gone down to 20%. So it adds to the puzzle. But maybe that means that there are some possibilities out there for meeting this difficulty.
If I can add something on this. So we talked about the rise in people who are out of the workforce because of long-term sickness. Very large rise since the end of 2019. But that rise has not been equal. There's been almost no rise in activity due to long-term sickness among graduates. It's all concentrated among people with lower education attainment, and especially among the over 50s. And we don't know for sure because the data is incomplete, but I suspect this is something to do with the types of jobs which are available to people. That there are some jobs which adapt better to remote working, and that may go alongside reduced ability for people to work if they cannot be in a job which does allow that.
Thank you. Thank you, Chair.
Very much, Emma. I'm just going to come to Julie in a sec. Before I do, could I just go back to a point that Rushanara was asking about independence? And I would agree with you. I think it's extremely important, particularly under difficult circumstances such as this, that we have an independent bank. I mean, the thought of politicians taking the really tough decisions around interest rates and perhaps a firmer monetary policy, which we might be thinking now, was appropriate in the past, just doesn't really shape up in my mind. I think it needs to be an independent institution like yours. There's been a lot of chatter and a lot of comments made in the press, and I know you don't like to comment on your discussions with government and ministers and so on. Have you had any signalling from government at all?
No, I'm happy to be clear on that. No member of the government has raised it with me.
Very good. Very pleased to hear it. Thank you. Julie.
Thank you very much, Chair. I'd like to go back to some of the global factors, particularly Ukraine to start with. Governor, the European Commission has said it's going to phase out supplies of Russian oil in an orderly fashion. What's your assessment of the impact that that's likely to have in the UK on energy prices and on growth and inflation?
Well, I suppose it depends what orderly means. If orderly truly is orderly, then I think we can manage it. But we'll have to see. I haven't seen what the plan is. I mean, I think a number of European countries have given sort of views on what for them would work. And it's worth noting, of course, that European countries are in very different places in terms of their dependence, particularly on gas. I think oil is less of an issue because oil's a world market, and you have to move it around, in tankers mostly. And I spent a lot of time talking to the commodities trading firms that, frankly, Russian oil is now, the supply of Russian oil is now declined. I mean, people just don't want it. It's trading at a discount, so this discount on Urals oil to the world market is now quite marked, apparently. It's more about gas and to a degree, as I said earlier, about distillates, because unfortunately Russia has quite large refining capacity. But I think gas is the issue because, as we know, gas comes down pipes rather than through tankers, well commonly. And that shift is taking place actually towards the LNG market. I think the situation, as I understand it, is that there's an interesting sort of mix here that the UK, as I understand it, has a larger capacity to take in LNG, liquefied natural gas, but less storage, but not much storage capacity, whereas a number of continental countries have far less capacity to take it in, but far more storage capacity, which is one of the reasons why on the sort of the front end of the market, our prices come down relative to the EU price at the moment, because it comes to us first, as it were, and we've got access to it. Now, I know a number of countries are now building LNG terminals. That takes, as I understand it, 18 months at the minimum, I think. So I think it's a matter of how orderly and sort of over what time the process happens. And of course, the huge pressure there is to do it faster because of the impact it would have, because I think there's no question that cutting Russia's earnings from gas off would be a very significant move. I mean, we are, of course, as I'm sure you know, in this position at the moment where there's sanctions on Russia, but at the same time they're earning a lot of income from sales of particularly of gas.
Thank you. Is it possible to strip out the proportion of energy prices increases in the UK that is specifically attributable to the war in Ukraine, or are the other factors? Is it just too difficult to do that?
Well, I think most of what we're so I go back to the 80%. Most of what we're seeing now is related to the war in Ukraine, unfortunately. And just to put that into perspective, I mean, what we've seen is quite a big. I mean, prices started to spike up last November, really, when the build-up of troops. I think technically it resumed, but it sort of resumed for real at that point. But then they really ramped up, obviously, when the invasion happened in February. So it's actually about the day we had the last hearing, I think, actually. We had a period until just before Easter when prices were very high. They've come off a bit since, but unfortunately the futures prices have not come off anywhere near as much as the immediate price. And the Ofgem calculation, for obvious reasons, is based on the futures price that will hold in the next period ahead. Although I should say I haven't been able to sort of really read it thoroughly, that Ofgem have floated a new methodology this morning, I think, for doing the cap.
So what kind of scenario planning do you look at when you're looking at the possibilities of what might happen in Ukraine, whether it's a prolonged stalemate, or whether it's an escalation, for example? Are you looking at that and different
we've I mean, just as we've recruited Chris Whitty to help us on COVID, we've had a session with a number of people who are experts both in that world in terms of foreign policy and in the sort of gas and oil markets as well, and we're going to do more of that, I think, for the next round. So we do that to help us. But I have to be honest with you. I mean, it's very hard to do the mapping from, let's assume that, you know, this happens on the battlefield, to what it means for sort of, you know, economic variables in this country. That's a pretty hard thing to do. You can do the general direction, but it's very hard to do an exact mapping in that respect.
So if I could shift to you mentioned it in your opening remarks, the upward pressure on tradable goods prices, particularly in the USA, and the shift away from services. And you mentioned COVID in that as well. Could you give us a little bit more about that, what you expect to happen? Why is it still being stuck in the USA? Why is that balance not shifted back? And what do you see the outlook on that?
Well, it's an interesting question. I mean, I think, as I said earlier, the US has seen a much more extreme version of the shift from services to goods, or at least the increase in goods, certainly. Bear in mind, the US had a different approach to fiscal policy. And this we think is the real drive. So the US, if you like to put it bluntly, handed out money. The UK approach was more to keep people's jobs in existence. So you can see that in the demand figures. So the big increase in demand for durable goods. Now, as I say, we were starting to see that sort of come back, and it's got interrupted. And I would say, I mean, you know, I was in the US not that long ago. COVID is more of an issue in the US at the moment than it is here. Much more of an issue in the US than it is here. We're unfortunately on the downslope. The US isn't. So, you know, that sort of COVID disruption in the US, I think, is continuing in ways that we're currently not experiencing. In terms of global goods pricing, that interacts with what we're also seeing in China, where, as I said, it appears now that the economic impact of the zero COVID restrictions is greater. Last year we were sort of concerned about it, but actually not seeing as much evidence of it now. I think there is much more concern about that.
We mentioned US and China. Do you look at the potential impact of a resurgence in the UK as well?
COVID? Yeah, I mean, that's why we were fortunate to have Chris Whitty's input. So yes, we do. And yeah, I don't think he'll mind me saying that. I mean, this is one of the paradoxes, actually, I must say. He's, I think, given a sort of quite a sort of what I call a seasonal view of it. And the UK evidence sort of supports that it is having a more of a pattern of a sort of seasonal flu type. It's more of it in the winter than there is summer. The US doesn't seem to have that, and I don't know why that is the case. The US is saying it's coming up as the weather's getting warmer. So I don't know why that is the case. And we will go on obviously monitoring that carefully. Plus also, as I say, getting the benefit of wisdom on the long COVID issue as well.
I mean, I
Sorry,
was just
Dave.
going to say on that. I mean, it was very striking last autumn that I remember we spoke to Chris Whitty after I think before and then after the summer break, and then there was a real focus on what was going to happen as the recovery continued with the ending of the furlough scheme, and then we had the Omicron variant. And I remember we had a very sobering discussion with Chris Whitty around the time that it became, it was being released to the public, just how infectious this variant was and the concerns about how serious it was. As it turned out, because of vaccinations and the nature of the vaccinated population in the UK, where quite high degree of vaccination, high degree of and focus on getting boosters. The impact on the economy was less than we initially feared. Having said that, we did put up interest rates last December, which at the time, if you recall, people were saying, oh, well, they must be, back to what we were discussing earlier. So the MPC, they are concerned about inflation because even in the midst of the Omicron wave, we were putting up interest rates, and we felt that was what the balance of risks required. I think what Chris has said to us more recently is that there's you can't rule out another either very infectious variant or indeed a more serious variant. It will just depend. Equally, they are looking to develop what I can't remember, I think they're called polyvalent or whatever, something like that, vaccines which act against different variants. So a bit more like the seasonal flu vaccine. So, we still, although we are in the UK, it's probably fair to say that the pandemic, the current state of the pandemic, aside from the kind of discussions we've been talking about in terms of the labour market, low participation, aside from companies adjusting their supply chains, the direct effect it's having at the moment, it's coming still through the prices we're importing, but we're learning to live with where we currently are on COVID, but things could change again. And as Andrew says, the seasonal nature means have to be alert, as we go into this autumn, and that will be another factor for us to take account of.
Could I just add to that, if you don't mind? I mean, I think it's really important to remember, and it goes back to what we were talking about earlier on, that the context of the discussion last Christmas, last winter, was around Omicron. And as Dave has just said, we knew it was very infectious, and there was a pretty good bet, actually, that it would be very deadly. Now, it turned out not to be the case, but at that time, that was, again, one of the guesses we had to make. I'll say one more thing, if I may, which goes back to the China issue. One of the things which I found very helpful that Chris Whitty has talked about is the context in which these things matter. So when Omicron struck this country, it was in the context of a vaccinated population. Andrew, I think you just mentioned that. Of course, the Chinese population, regrettably, is much less widespread vaccinated, and therefore that's why the Omicron is much more serious. So one often thinks, goodness, aren't we done with Omicron? Aren't we done with COVID and all of that? But actually, Chris Whitty, I think, helps us to remember that context really matters when we're trying to then think through what the economic consequences might be. Thanks.
Thank you very much. Thank you, Chair.
Thank you very much. Judy, go to Alison, please.
Thank you, Chair. The Monetary Policy Report states that it's likely that the strength in pay growth can explain some of the recent rises in services inflation. So if I could ask you, Governor, how concerned are you that pay growth appears to be feeding into inflation?
Well, I mean, we are concerned. I mean, that's why the second round effects are of major concern to us, and that's where, as we were saying earlier, we think monetary policy will have its most effect. The first round effects, I'm afraid, as we were saying earlier, we can't make a difference to because they're coming. The second round effects are important, and therefore we pay a lot of attention to pay growth. We have, in the latest monetary policy report, increased our our assumption on the rate of pay growth coming through this year. That's based on a mixture of things. It's based on evidence from our agents. It's also based, obviously, on the path of inflation itself, because there's a feedback to it. So to give you a sense, I mean, I think our view of underlying pay growth back in February this year was probably around 4.5%. It's about sort of 5.5% now. And that reflects, as I say, that mixture of evidence. And that has I think for each of us, in the way we think about the decisions we're taking, it's that has a very significant effect. And, we're going to get some more labour market data tomorrow morning.
It is important, though, to emphasise that it really does differ very, very much between sectors and industries, and linked also to the ability of firms to rebuild margins and pass on higher margins in terms of final prices, and equally the wage bargain that happens in those businesses. You do see this pattern and I think we've got this from our surveys, because we've surveyed both on wages, but also most recently on pricing, that the closer businesses are to the consumer, the more challenging it is at the moment to pass things on, because it's consumers that are they're the ones who are dealing with the cost. They're seeing the cost of living challenges in their household outgoings. They've had the energy price increases in April. They'll be thinking what might be to come. They've also got the food price increases, and when you talk to retailers, they're in they're also got the challenge of how do they retain and recruit staff, but they're also very conscious from what they're seeing from both their low-paid staff potentially, but also their customers, of just the challenge there. So, they're almost dealing with a similar trade-off to the one we are dealing with, because they're thinking, how can we sustain our revenues while seeing what our customers are bearing the brunt of.
And retaining staff will put pressure on put pressure on corporate margins. That's, of course, one of the things that will come through. Sorry, Michael.
Sorry, if I could add something on. So there's no problem with having high pay growth that's backed by higher productivity growth, right? That's how living standards rise over time. And, in a market economy, it's quite normal for some sectors to be doing better or worse, and pay growth in different sectors to be stronger or weaker. The issue which you've got at the moment, you've had for the last couple of quarters, is of generalised capacity pressures, strong underlying pay growth, and also firms believe they can pass those cost increases on. Right, so I have to say I'm as concerned about firms' pricing strategies, this sense that they think they can pass those cost increases on. That's really a picture which I would like to change.
You highlighted, I think, in your evidence about the difficulty with no cumulative growth in labour supply as well. Can you tell me a bit more about the problems that causes, and is there anything monetary policy can do on that front?
I don't think that monetary policy can really affect labour supply in a significant way. So an argument gets made sometimes that we should, quote, run the economy hot in order to draw people into the workforce. But as you can see in the data, the factor which has caused participation to fall is not a lack of job opportunities. It's a rise in long-term sickness that is surely linked to the pandemic. And I think if we were to, quote, run the economy hot under those circumstances, we just tend to get higher inflation, more embedded inflation expectations, and a bigger problem to deal with. I do think the issue of long COVID and the pandemic's effects on public health and participation is a very serious issue. It's just not one which monetary policy is well designed to tackle.
Yes, there's effect from Brexit as well, with people not coming into the country to work.
Yes, that's right. Okay.
You'll be aware that we were told by the witnesses last week, economists including former MPC members, that in the US a wage price spiral has begun, and they believed that we're in the beginning of one here. Would you agree with that?
Well, can I come back to the point I made a few minutes ago about the different nature of the shocks that are affecting the US and the UK? And actually, it's quite helpful to bring the euro area in here as well to just paint the whole picture. So the US, I think, is experiencing what I said was an upward pressure on demand and on inflation. And it's unsurprising, I think, that there's therefore a concern about wage pressures, and there is. It's got, like here, it's got a very tight labour market. Euro area, like us, is experiencing this very big real income shock caused predominantly by energy prices and goods prices, but doesn't have as tight a labour market as we have. So I would sort of draw the distinction. We're sort of a bit hybrid in that sense. We've got US labour market, but we've got the same sort of trade-off and shock as more or less as the euro area. So the distinction I would draw with the US is that they have got, because they've got the sort of demand shock and inflation shock, that the risk of a sort of wage spiral, I don't like using it, but I'll use it for the moment, is greater. We, I think, and I go back to it goes back to what Michael was saying earlier about, how we view each decision on monetary policy, have to watch this very carefully, because we do have a tight labour market, but we are dealing in this world of a trade-off. And the question, and a number of colleagues have mentioned this, is the business world at the moment, I would say, particularly the ones I think we talk to, and I'm not saying this critically, by the way, please don't think that, doesn't see it coming because they're worried about how they recruit and retain. But there is a very big shock happening, and it's not coming, it's already started to come. And that will, I think, affect, as our forecast indicates, will affect labour market conditions going forwards.
So, I mean, just to build on that, you are seeing some evidence, and Michael's referred to this in recent quarters, that there is some inflationary influence coming through on wage bargaining. And I think it's very important that, and we've all referred, I think Andrew mentioned the figure, we see wages, the forecast we put out for wages sees them growing by, I think, earnings by 5.75% this year, which is up from what we were forecasting 3.75% in February. So you are seeing the beginnings of concerns around inflation influencing wage bargaining. So I think it's really important, therefore, that we take the actions that we can to ensure that doesn't become embedded, whether in wage bargaining, but also, as Michael says, equally important in pricing behaviour of firms. Have to avoid that inflation mentality, which you're beginning to see the signs of taking hold, and that's why we tightened policy in 4 successive meetings. And bank rate has now gone up to 1%.
Is that having an effect, though?
Yeah,
you're talking about it going up, and the report also suggests that this will go up again.
I mean, it's having an effect, and we document this in the monetary policy report in the usual ways. In that, if you want to borrow money to buy a house, for example, the most popular mortgages have gone up by over 1% over the last year. So 2-year fixed, 5-year fixed, those rates have gone up by over 1%. So if you're remortgaging now, it's going to cost you a lot more than if you were remortgaging a year ago, and that means you're going to have less to spend on other things. That's just one example. And as it reduces demand in the economy, you will see, therefore, that the pressure eases in not just in those who are borrowing money, but more generally. So it is having an effect, and it will continue to have an effect.
Can I ask a little bit about expectations of inflation? Kristen Forbes, Professor of Global Economics at MIT, told us last week that public expectations of inflation in the medium term are higher in the UK than in the US and the euro area. Do you agree that higher inflation expectations are a greater risk in the UK than elsewhere, and how much of this is a source of concern?
Oh, it is a source of concern. I mean, it's something we watch extremely carefully. I mean, I'm afraid, it's not surprising, given the increase in current inflation, that it does feed through to expectations. It feeds through, by the way, more to short-run expectations than it does to long-run expectations. And we are more, our relative concern is more on medium and long-term expectations, because that's where it can become embedded. And that's why, obviously, the most important thing we can do in that respect is to get inflation back to target. and to get it back to target without sort of unnecessary disruption to the economy. But we have to get it back to target. That's clear.
And to Michael Saunders, you'd mentioned, I think, in your evidence that the process of re-anchoring price expectations could be very costly. Could you tell me a bit more about that and what that would mean?
So this is in terms of the cost of monetary policy action versus inaction. So I would not say that inflation expectations are de-anchored at the moment.
You said they were uncomfortably high.
They are uncomfortably high, yes. So for me, when we're making our policy decisions with the various uncertainties that we've talked about it, the potential cost if monetary policy does not tighten promptly is that inflation expectations could rise further. And then you reach a point at which getting inflation expectations back on target, and hence getting inflation back on target, becomes increasingly costly in economic terms. And that's a scenario which I would want to avoid.
Okay. Thank you very much.
Thank you, Chair. Andrew, can I ask you about forward guidance?
Yes.
Which is, I guess, tricky at the best of times, and particularly tricky right now. You got in a bit of trouble last kind of November, I think, when you'd said that because of inflation pressure we'll have to act. This is another meeting, central bankers meeting, whatever, and that action would come in monetary policy meetings. And about 2 weeks later, 4th of November, you decided not to act based on the furlough. I think you said earlier.
Well, I mean, I can be clear. I didn't say when we were going to act, and of course we have acted.
Okay. No, that wasn't really my question. But you weren't precise about when it would happen. But you said the market took those indications that you were going to. Yeah. I think that's the key to this, isn't it? It's what the market will reasonably expect from what you've said.
Yeah.
Just really, I guess the key thing is, I mean, okay, it's the furlough scheme, and there was uncertainties around that. But there's also other evidence, wasn't there? I think in the minutes of the meeting from November, it said the ratio of vacancies to unemployment is the highest for 20 years. Companies are reporting acute shortages in a range of occupations. So there were some uncertainties, but also a huge amount of pressure that most employers were seeming to be experiencing. Did that not weigh against? Was that not a factor in the fact you should have been putting on interest rates over that point?
That was. I mean, I think I've said at a previous hearing. I mean, that was a very, to my mind, very difficult and very closely argued and close decision. The question that was weighing on us is that at that point in time, we had no read of the labour market post the end of the furlough scheme. The furlough scheme ended in end of September. And it wasn't until the December meeting that we had a read of the labour market which didn't have the furlough scheme in it. And that was the question. The question which I think, certainly I weighed very, very carefully was, is it November or is it December? How much confidence do I need to have around the impact of the end of the furlough scheme? Going back to something Dave was saying it earlier, just the sheer scale of use of the furlough scheme right up to the end of it. And the puzzlement we had as to, well, really, are these million people going to be reabsorbed back into their jobs, or are they not? And that would have created, very different outcomes.
I mean, I think you said earlier, the more understanding of different factors we have, the better. But one of the factors I'm surprised didn't seem to be in those minutes, and indeed it wasn't in your written submission to this committee for this meeting, and wasn't mentioned until Rushnara asked a question on it earlier, actually, which is Brexit. So, one thing with net migration, you said the figures are uncertain. Well, the figures are pretty certain that in 2020 they dropped by 88% net migration, from 271,000 to 34,000. Yet that's not mentioned anywhere in any of your...
I'm not sure how certain it is. I mean, the ONS, no criticism again, stopped the passenger survey during COVID. So we went for quite a long time without having a line of sight, I would say. Can I also say, I mean, you said Brexit. The challenge there, as I said earlier, is that in that area, but Brexit and COVID were having the same effect. Both of them were causing a fall, obviously, in mobility of people, you can argue. I think COVID was the more proximate one at the time, in the sense that because of just the restrictions were doing that. And indeed, that's what many employers tell us. Now, going back to the numbers we were talking about right at the start, I think the sort of numbers we're seeing at the moment, we talked about the inactivity numbers, and we talked in numbers in the range of around 500,000 people, bit over that. The sort of numbers I've seen for net migration are probably 100,000, something like that in that period, over time. Now, I may be, we may be looking at very different numbers, because the numbers are...
Those are the ONS figures.
Sorry?
Those are the ONS figures from 2020. I wondered really, are you looking at this now? Is it changing? Yeah. Because that's a massive reduction. One thing all of us as members of Parliament see when we go around to talk to our businesses, everybody's saying similar things, and your agents out there, and indeed you guys.
You see the same, and we do.
And they'll all be saying, whether it's people picking fruit off the trees or it's working in our pubs and restaurants, everybody's saying the ready supply of employees we used to get from Europe is just not happening.
Yes.
Yet, what I don't understand, it just doesn't feature in any of your guidance. It's not mentioned anywhere. Well,
I don't think it's as big as the effect we were talking about earlier, the inactivity effect. If you'd like, I'll happily write back and we'll go and gather all the numbers together that we have, and I'll see what we can set out. I'll be happy to do that.
And it has featured in our analysis, and I talked earlier about very difficult to disentangle the interplay.
I understand that.
Yeah.
But our guidance, which is where you started, which is going back to last autumn and our use of guidance at different times, is around you build on that analysis to then try and communicate, framed by that analysis, where a message you want to get across about where policy is going, and and then there's a question of what you actually do on policy. But we currently, and I think it's implicit in what we've all said today, our current guidance. Most of the members of the committee think that further tightening in policy is going to be required, and that comes back. But that comes back to the point about labour market tightness. There's an issue about the part that Brexit or something else plays in that, but our guidance is framed by that analysis of the labour market and that analysis of firms' pricing policy. So it is there. No. It's just not it's not the top line of the guidance.
And just to add, the number I quoted right at the beginning was the total size of the labour force.
No, I don't dispute that, but it is a key factor. Yet it doesn't seem to be something that you are dealing with in any material way. According to the IMF, the UK is going to be much worse over the next 2 years, average in terms of inflation, 100 basis points. UK 6.3%, US 5.3%, Germany 4.2%. Adam Posen, which was mentioned earlier, says 80% of that differential is down to Brexit factors, both non-tariff barriers and labour, yet it's not featuring in any of those.
The second, obviously, Brexit issue is trade. Now, the Bank of England has not changed its view on Brexit and trade for some time. We have built into our view of the future that there is a negative impact. It's been unpopular. My predecessor was unpopular for saying this.
Well, that's my point.
No, but hang on. We haven't changed our view. In fact, I would say, on the basis of the evidence we've seen so far, which is hard to pick out from COVID, but on the basis of the evidence we've seen so far, the path we basically laid out some time ago, which was there would be a negative effect on trade, and it would take a long time for the economy to adjust to that, but it would over time, because that's real convergence does occur. We've really not seen anything to change our view of that. So that effect, that negative effect, is built in.
Well, that was my question, I guess. Is it because it made your predecessor unpopular that you're just steering away from it? Because you are steering away from it. It's quite clear.
No. We haven't changed it. It's there.
Yeah, but you still stop mentioning it. It's still a factor. If it's still a factor, surely you keep talking about it. You shouldn't be afraid of it. This whole inflation thing, we all know is really short term. It's transitory, in your words. So, but it's going to have Adam Posen, 80% of the difference is to do with these factors. This is very significant.
Well, the point of, can I just come in just to put some data into this rather than some possible forecasts. I mean, if you look at the data for US, Euro area and UK inflation in the first quarter of this year, so that's the latest quarter for which we have data, the US on the PCE measure is 6.29%, 6.3%, the Euro area is 6.2%, and the UK is 6.2%. So those three big economic areas have got the same inflation at present.
So you don't think Brexit is having an impact on inflation?
No, I didn't say that. No. I said it's very difficult to disentangle the interplay
yes, I get that.
From the pandemic on global supply chains, on imported goods, on energy prices. But inflation is a global phenomenon at the moment. Those three big economic areas all have same inflation.
It's the differential impact, I suppose, is the point. And wouldn't it be sensible to raise these? I mean, I know it's maybe baked in your view. Everybody knows about that stuff, and we're trying to get away from Brexit. But nevertheless, it is a factor, and it's a factor that might sustain inflation or keep it above where it could be. But it just appears, maybe you, like you said, the popularity thing, is it not that you fear upsetting somebody by not referring to it?
Look, it's built into our view of the supply side of the economy. The trade share of GDP has declined, and declined more in the UK than elsewhere. That's a fact. It's built into our view of the supply side of the economy, has been for a long time. I think there is a point that we tend to sort of focus on probably the things that are new influences more than the things that are long-lived, but that's not surprising in a way. Otherwise we'd be writing the sort of, the vast tome every quarter.
Do you think it should feature a little bit more heavily in future in terms of this, if this is a potentially, in fact, even though you can't distill it in terms of COVID and labour?
Could I add one more thing, if I may, Andrew, if you don't mind? It's, of course, we do ask. So one of the issues of Brexit is the uncertainty that the whole Brexit process brought to firms. And of course, we do ask firms what their top sources of uncertainty are. And over the time of Brexit and so forth, in our decision maker panel survey, it was a very high source of uncertainty. Regrettably, because of all these other horrible shocks that have been going on, it has become less of a source of uncertainty. So I think, relatively, thank you, yeah, that's right. So there's a sense in which we naturally write a bit less about it because those other things have occurred, but that's based upon the evidence that we gather from what firms think.
It still is potentially a material effect. It just seems to me, would it not be sensible in the future to refer to it?
We'll take that.
The most material effect, as Andrew was saying, is the trade intensity point, where as a result of lower trade intensity, we made estimates before that the long-run impact of Brexit would be about 3.25% off GDP in the long term. I mean, I remember when I was here back in September, I gave Russian Ali that figure. That figure hasn't changed, but that's a long-term impact, and it's very hard to to track that from one quarter to the next. Whereas I guess what Andrew's saying, what we're all saying is these shocks have subsequently come along, which we think are having more impact, for example, in the labour market, because that Brexit effect was all about trade intensity. And that's that was like a 15, 20-year estimate for it. So you're not going to spot it from one quarter to the next. Whereas what we are seeing, and why we're emphasising them to you, is these very significant effects on labour market participation, for example, from the pandemic.
One final question, if I can, Chair. Just the chairman of the Law's Economic Affairs Committee, Lord Forsyth, accused you of being ostrich-like about this. He says the first thing you should acknowledge, looking back, benefit of hindsight, is that we were wrong not to increase interest rates in that November meeting, and then move on from there. So at least we say we got it wrong, and then we move. Is that fair or not?
Well, I think that would be retreading the ground we covered earlier, if you don't mind me saying so. I mean, I've said that the November meeting was a very close call. I've explained why, certainly for my part, I took the view that I did. That was based on the facts that we had at the time.
And we did put up rates in December with Omicron happening. So would a difference between November and December have really made a huge difference to where inflation is now? I mean, one can debate that. But we did put up interest rates in December. People commented on the fact that we were doing it even though we were in the teeth of Omicron, and we put them up at every meeting since.
And we made a big call on Omicron that it wasn't going to have as big an effect.
Thanks, Chair.
Thanks, Kevin. I go, please, to... well, I was going completely blank. Harriet is next. Yes, I just wanted to check. I thought it might have been somebody else, but it is you.
Thank you very much, Chair. That's also my understanding, as it's my turn now. Yeah. I wanted to open by congratulating the Bank of England on 25 years of independence and acknowledge, I think it was Gordon Brown's greatest legacy, so we'll have some cross-party love over this, and say that over that 25-year period you have essentially achieved what you've been asked to do in terms of the 2% inflation rate. I also accept what Michael has said today in this session, that it would have been very difficult for monetary policy to keep us on track for 2% given what's been happening externally. So I do accept that as a premise. And, you know, back in March 2020, you brought in some very strong monetary stimulus. You did a lot more quantitative easing, and of course the government did a lot of fiscal stimulus. And what I'm not going to accept, though, is that there is no opportunity here, and you can't blame just not hindsight and the war, I think, for missing the target, because my personal view is that there were, because I'm on the record as having asked you about them, there were some telltale signs that the risks to inflation were to the upside. So, you know, back in as early as September 2020, after the first reopening, we were seeing services businesses like hairdressers, like theatres, you know, putting up their prices quite significantly at that time. And then I asked you a year ago about the experience that people in my constituency were seeing in, you know, the timber market, cement market, price rises, you know, into almost 3 digits at that point. And then by November, we were really, with inflation up at 5%, you know, I was highlighting the vacancy levels in the economy, the living wage intention of the government to raise wages and so on. And so, you know, I think I've been on the record as saying that there were some significant inflationary risks in the economy, which I'm not happy to see come true. So I do now want to turn to quantitative tightening and how you're going to go from here back to getting policy back on target. And I noticed some research from, I think it's ING, who said that a good rule of thumb in terms of quantitative tightening is that for every 25 billion of gilt sales in any given year, it has a comparable tightening effect on financial conditions of about 1/8 to 1/4%. Would you accept that, Governor? Does that sound like a reasonable rule of thumb?
I wouldn't. Let me explain the reason why. One of the things that we've said a lot about quantitative easing, and indeed I've published on the subject, is that its effect is state contingent. And it has more of an effect, particularly in the conditions that you referred to a minute or two ago, where there is dislocation. So March 2020, and also post-global financial crisis, it probably had its biggest effect. And a lot of what we did, I would say, thereafter, going through 2020 last year, was actually providing a degree of insurance in terms of keeping rates further down the curve.
Can I just clarify my questions about quantitative tightening, not
that's the reason
easing,
I'm coming to it. There's a reason for saying it, starting here. So the effects are, I think, they're not consistent over time and they're state contingent. Now, we know far less about quantitative tightening. We've never done it.
We know nothing about it.
Well, we've never done it. The US has done it a little bit.
Okay.
So, you know, we don't know a lot about it. But let's assume that it's basically symmetric for a moment. I mean, let's assume that there's a symmetry between quantitative easing and quantitative tightening. In that case, you would expect the greatest effect of quantitative tightening to be in, you know, in difficult market conditions, i.e. we mess things up. I mean, we've said on the record, and I've said on the record, you know, let's assume we take the decision to go ahead with it. But we're not going to do it in, you know, disrupted market conditions. We're not going to just blaze away and whatever's going on in the world around us, however disrupted markets are, we'll just keep doing it. You know, we would do it in what I would call orderly market conditions. We could suspend it if necessary, because we always suspend it.
You could do a little bit every day, couldn't you? And just have a very predictable amount.
Well, we will aim to do that. I mean, by the way, we're starting a series of engagement with the market now to answer those sorts of practical questions, and to answer the question, do we do single stock auctions? Do we do it every day, every week, every month, whatever? My point is this: we will do it to minimise the impact of it, because actually we want to. Bank rate is our preferred tool of monetary, always our preferred tool of monetary policy, because we know far more about its impact. So our aim with quantitative tightening is really not to have another monetary policy tool in operation. It's just, I think it is very sensible now to unwind the balance sheet over time.
Okay, because you've been very clear up till now that you wanted to use the bank rate
Yes.
for the first move up to 0.5 and then to 1%.